Welcome to the Collecting Keys Real Estate Investing Podcast with your host, Mike DeHaan and Dan Austin. From wins, losses, horror stories, and tactics for optimizing your business, Mike and Dan take a real, uncensored deep dive into the ins and outs of running a full-time real estate investment and wholesaling business.
What's going on, guys? On this episode of the Collecting Keys Real Estate Investing Podcast, we have Eric Rice with Rice Pegher Capital, and he is an investor out of the Pittsburgh area, specializing in not only multifamilies, but also historic mixed use. Was it historic Okay, I'm going to try one more time. Historic mixed use commercial properties. And what the hell does that mean? I don't even think we have those on the West Coast because we're too new.
No, you have to. So picture a small town outside of like a major city with a, 3 to 10 block main street with a bunch of really cool old buildings that maybe need some love, that happen to be in the path of progress. So we jump in and we buy those in some different areas and kind of renovate them and put them back to their kind of highest and best use.
Gotcha.
Nice.
Okay,
nice.
Perfect. So helping keep the charm in some of these older neighborhoods,
small towns,
downtown. So cool. So you're crushing that. You're buying multifamilies, and also you're also one of our marketing clients that has recently joined our ranks, I guess, of people that we've been working with. You're in the Instant Investor group, and you are one of our premium clients. We're doing the marketing for you. That's been crushing out there on the East Coast. Mm-hmm. So awesome. We're glad to have you, Eric. I'd love to hear just kind of like your background and sort of the stuff that you're working on right now. Cause I know you've made some shifts recently after being a realtor for a while and getting into this endeavor. So how did you get into all this, and, what is your plan of everything you're working on right now?
Yeah. So, really I had been a licensed agent for kind of the past 12 years or so, pretty successfully in the Washington, DC market. And then, for the last 10 years or so in the Pittsburgh market. The thing about being a real estate agent, it was great. I loved it. I got to work with all kinds of great people. I had a great time. I was able to make a great income. But I always felt the whole time like I was kind of working and taking all the risks of having a business, but then didn't really have a business to sell at the end. And when I stopped working, the money would stop coming in. So 6 years ago or so, I started to kind of take that a little bit more seriously. I was like, all right, I got to buy some properties, create some long-term income, or at least some additional income stream. So I bought my first property at a flip, I think probably in 2015. And then that one took a year. I think I lost $5,000 and,
there you go.
And,
loving it.
So I did it all wrong. Then, did a couple more in a more successful fashion, then jumped kind of all into to multifamily investing after that with a couple of partners.
So the one flip, you're like, and then you pivoted. Is that what you're saying, or have you continued to flip?
I did the one flip. I did it all wrong, and then I realized all the right things to do, and I bought one really right, and I did it correctly, and it was done. I think we paid $200 for it. We put 27 grand into it. I had the contractors in there the day after closing. We were on the market 3 weeks later. 3 weeks after that, we were closed with a $300,000 offer. So we made,
beautiful
60 grand or something like that on that deal in about 45 to 60 days, something like that.
Yeah,
so that's how it's supposed to be.
Yeah,
yeah, right. That sounds way better than spending a year to lose $5 grand.
Yeah,
I mean, there's a lot more fun ways you can do that than trudging through some terrible rehab. And the thing is, too, I imagine that one that you lost on, you probably used hard money or something on.
I used all my credit cards and a home equity line of credit.
Boom. That's how you do it.
So even on that, like, you were totally just a victim to the financing on it. I bet if you had gone faster, you hadn't had as much money cost, you probably could have
definitely 5,000 margin on interest rates when you're using credit cards. Yeah. One thing that you said too that's really important that I see a lot is, as a real estate agent, you said you were taking all the risk of having a business, but not all the, if you stopped working, your money went away. So many real estate agents, successful real estate agents, fall into that category where they're like busting their ass. They're killing it. They're at the top of their game. But if they stopped working tomorrow, all of their income's gone within 45 days. Whatever they have left in escrow, all of their income's gone. And so that's really important. Like what you said, just to pivot at some point in time to start actually having that like passive cash flow. Because man, none of us want to work all day, every day for the rest of our lives.
Sure.
Yeah.
Yeah. I mean, I love working.
That's why we're here.
I just want it to stick around. I want the money to keep coming when I feel like taking a month-long vacation.
Yeah, exactly. That's so important.
Yeah. I mean, it's interesting. And then like, no matter how big people get to, I mean, unless they're really wise with it, that seems to happen. I went to lunch actually today with a pretty big realtor in town here, and they were just crushing it the last couple of years. And now he's kind of a situation of like, I don't even know what we're going to do.
Yeah.
Like,
He's like,
yeah.
Yeah. Because as much as you don't want as much as you don't want your spending to grow with your income, especially a fast lifestyle like that, where the checks come in big and fat and almost always come in, but not always. Like it's easy to let your expenses get too high.
Mm-hmm. Especially if you hang out with other rich guys.
Yeah. Well, especially when it's like all realtors and it's just like a dick measure.
I drove a 2007 Toyota 4Runner with 200,000 miles on it. So I was not the typical Mercedes-Benz.
Driving a BMW.
Yeah. That's how Dan used to be. And then, he's all into like wants to get his Tesla. He's got his big fancy house. I'm cheap, but you did, when you said that you paid $27,000 for a rehab, it made my heart just freaking drop because I've got a contractor out there right now building a shed that's probably going to cost me that much.
Yeah.
I'm like, God damn it.
Yeah. So no, that's awesome though. So you start getting into larger projects, and then I guess those first ones that you started to get into, were those the historic mixed use style of properties right off the bat? Or?
Yeah, it was kind of a mix in another small town outside of Pittsburgh. It was a dirty portfolio, like the second half, which is the shitty half of a portfolio from an estate, and I think it was like 39 units, and the biggest thing in it was a 12-unit apartment with, I think there was 9 apartments and there's 3 ground level retail spaces. And then it ranged, from that to some smaller multifamily to like some abandoned houses, a vacant lot. It all came with the portfolio. And I think we paid $1.223 million for that. And then budgeted about $400K in rehab dollars so that we could turn the stuff we wanted to keep and bring the rents up. But it was like, it felt fairly risky, and it probably was, but it ended up fantastic. I mean, we were able to cash out. I have 2 partners. So when I did that, I brought on my brother and a friend of ours as a partner. So there's 3 partners in the company. And we split everything, equally. And we were all kind of like, all right, let's do it. We all kind of put boots on the ground and hit it pretty hard. So I think on month 11, we refinanced that and cashed out 85% of our initial principal.
Nice.
Great. So awesome. When you say that, what did you have to come to the table to put this deal together with?
I think we each came to the table with about 140,000, something right in that, very close to that. This was at the very beginning of 2018. So we worked on the deal through the end of 2017 and closed, I think, early 2018. And
gotcha. And then you guys had to just split the $400K as you spent it for the rehab, or did you guys have that wrapped in your note?
We rolled that in. So had that construction financing piece in there. So we brought 20% of purchase and construction dollars.
That's a great strategy right there. And I love it, like bringing in the partners. So you said you were all three kind of boots on the ground. Did you each have separate roles in this, or were you guys just kind of like, let's figure it out together? We don't know what we're doing.
We kind of
let's see what happens.
Yeah, we just kind of figured it out together, I would say. Clayton and I were both in town. My brother still lived in New York at the time. So he was doing everything he could do for the company kind of remotely, because we were also literally like just standing up the company at that time as well.
Mm-hmm.
So he was doing a lot of remote stuff. And then Clayton and I were kind of heavy boots on the ground with contractors, working with the property management company. We used a third-party property management company initially on that project because we didn't have scale to do it ourselves.
Gotcha.
I would not be great at property management.
Right. So is that the name of your company? This is such a tangent. Rice Pegher, is that your partner's name, and then you and your brother are Rice?
Yeah. We've tried to get him to change his last name to Rice because it would be more simple, but
I was thinking change it to baby, then it could be rice baby.
I like that.
That's so dumb.
Go play with your kids, Mr. Dad Joke. Jeez, what is that?
I was waiting this whole time to find a good spot to bring that out.
Man, so awesome. So that was, pretty good first deal. Now, so that was your first historic mixed use deal. And then after that, did that become like a niche that you started to pursue? Like,
yeah,
I mean, that's super unique. Like, what are the nuances that even come along with that?
Yeah, so it was a niche that we kind of, I would say, we were looking to buy apartments as well, and we were doing that after that deal. But we really got into it more in the town that I live in Selianople, Pennsylvania, which is north of Pittsburgh, small town, kind of same old historic mixed use street that I kind of explained before. And we had an opportunity to buy this old building. It had been a restaurant, but it had been shut down for like 8 years. The roof was gone mostly. It was just a total disaster. Nobody else would touch it. And we were kind of like, well, this doesn't look that different from what we bought. We could probably do this. Mm-hmm. And I think we leased most of that space up before we were even maybe officially under contract. Like, we had the LOI out, and I just went and started talking to people and was like, hey, would you be interested in this space? And so they were signing like letters of intent as we were signing the contract. So we decided that it was a model that would probably work.
Interesting. Okay. And so when it comes to something like that, historic mixed use properties, I imagine there's sort of like rules and regulations around how you can modify the building, things you can do. Like, is there rules around like the kind of tenants that you can have?
So a lot of that really depends on what type of a district you're in. Our buildings are historic in nature, but not in a technical registered historic district. That comes with a lot more nuance and a lot more regulation. We, have to run some things by kind of town council, and we, just by default, we want to make them look kind of, like a really, really good version of what they would have looked like originally. So we kind of stick to those criteria on our own. And then we're limited, just like any other commercial property, in the types of tenants that we can put in by the zoning laws that are in place. Mm-hmm. So we do have like quite a bit of free reign as to exactly what we do with the properties. We just kind of renovate them in a historic manner. So, in a lot of cases, mm-hmm. where, for example, you were taking a piece of original baseboard from the place, taking it to a lumber mill, having them make a new die and cut, mill all the baseboard to match the original. So just lots of little details like that make them, stand out, or restoring the tin ceilings that are in place or something like that, which makes it unique for the tenants to come into and set up their, their cool spaces, whether they're a restaurant or retail. And also makes it cool for customers to come in, off the street, and they're like, oh, wow, people really appreciate it. Mm-hmm.
Gotcha.
Right.
That's interesting. I bet that varies by like just area too. Certain places that probably have like more, I don't know, emphasis on their history and their culture. I don't know. Maybe they don't want a Nike store in like the old building. Sure. They want it to be like some sort of mom and pop thing, because it creates like that sort of microculture. Yeah.
Well, I have to imagine too that the niche that you're not talking about too, or you haven't talked about yet, is like small towns that maybe are just thirsty for this money to come in, and you just get away with a little bit more as long as you're doing right by the city or the town. They might be more willing to help you.
Yeah, it's very collaborative. So from the beginning, in all the different little markets that we work in, we almost always go right to the borough office, introduce ourselves to, the borough council, the borough manager, the police chief, kind of tell them who we are and what we do. And we found that to be extremely helpful in terms of getting things done. And if they know we're doing the right thing and there's a level of trust there, it's very helpful.
Absolutely. That you're a person and not some big company, some big development company coming in just to straight, pull money out of the economy, but actually put back into the community.
Yeah. We're not stuffing Dollar General stores into every available store. You know what I mean? We're trying to.
Oh, I do know what you mean. I do know what you mean.
Yeah, you don't live in, I don't know, I feel like there's certain states, like southern states, that are super red, where they're just like everything's capitalism, and they just like shove them in everywhere that they can.
Oh man, they got the historic stuff.
No, yeah, it's true. Like, have you ever been down to like Florida, for example? Someone in Florida listens to this and like shit on me, but it's like every single strip mall has a Cracker Barrel.
Yeah.
Like, why?
Yeah.
Like,
because it's good food. It's good quality food and family fun.
It's family fun.
It's like they could put anything in there, but Applebee's wants to go in there. They're just like, no, this is a Crackle Barrel steak. Like, get the fuck out of Applebee's.
You called it Cracker Barrel. You can't even. They're really gonna jump down your throat, man.
Yeah, I know. Probably. Sorry, I'm not part of the Florida culture. We're literally as far as you can get while being in the United States.
This is true.
But although I do
funny.
love their beaches, they're great. No, that's super interesting though, and I feel like that's a good balance to the bad rap that a lot of real estate investors get. Because kind of the typical view that people look at like real estate investors, they're like, oh, they're going to come into like this historic area and throw up like a super modern apartment complex. They're just going to completely butcher all these old neighborhoods. But you're doing like literally the opposite. You're basically creating modern amenities and while still maintaining the sort of historical aesthetics to the building and the neighborhood.
Yeah, and it's not a charity. We're also we also do it and make money. So it does work for anybody that says you can't do it well and still make money. They're maybe they're in a different market than me.
Yeah, right. I mean,
right.
Yeah, or they're just ignorant. Let's be honest. But no, so that's cool. So, how many of those sort of projects have you done now? Like, what's your portfolio look like? Do you usually keep all those? Do you like flip them?
No, we've kept everything so far, except for a couple of like really rough pieces of that initial portfolio of stuff we bought. But all this stuff, all the historic kind of renovation stuff that we've done, we keep. I'm sitting in one of them right now. So we have our offices here. We've got 4 buildings in this town done, and we have 2 more in the works right now. So one that we closed on like 4 weeks ago. We're working with the architect to do the design, and one that we just finished architectural design on that we're doing our contractor bids starting next week. So that'll be rolling hopefully in January.
That's cool.
Yeah, and they vary in size from 5,000 square feet to 15 or 18,000 square feet per building.
Okay. And what's typical purchase price for something like that? I know that varies by market,
Ranges,
but
yeah.
I know a lot of people, they tend to think things like that are incredibly expensive.
Yeah.
Which, I mean, I'm sure they can be, but
yeah. So for instance, the building I'm sitting in here, I think we bought this. This is it's 3 levels. Each level is about 2,500 square feet, and then it's got another couple thousand square feet on the back of it. I think we paid $375 for this, but then I think we put in $1.1 million, something like that.
oh wow.
So
Okay.
It's a good amount of money. Was that also wrapped in a construction loan?
yeah, we financed a lot of that, but then we went over budget on that quite a bit, and then we refied them recently, and we tied 2 or 3 of these buildings together, and we cashed out. I think we're out pretty much all of the money that we put into them. So.
Oh, nice. It was the shiplap in your background. That's what got you on the budget.
Gotcha.
The shiplap. Yeah. That's a good point. Actually, I want to talk about for a second. So you said on the first deal, you burred out 85% of your capital. So you didn't get it all out. Obviously 100% burr is really cool, but I'm assuming, so you paid $375 for this one, put $1 million in it. And I'm trying to drive to a point here, but would you say at $375, you paid what it was worth, right?
Yeah.
Like,
mm-hmm.
You're not
anybody else that had been in this town for a long time thought it was worth, and then we put more money into it than anybody else was willing to.
Yeah.
And then we got a valuation based on an appraisal higher than anybody thought you could achieve in the area.
Right. Well, I think that's just a great point. And Mike and I, because, we love a good deal just like anybody else. But we've talked about a lot lately is like, what's wrong with paying like what a property's worth? The value add can happen still. You just need to pay for what it's worth. You don't need to pay or negotiate what it's less than it's worth just so you feel like you got a deal. It's okay to pay what it's worth. And sometimes it's okay to leave some money into it because there's still a return on your investment. That's what a return on investment means, right? There is an investment. So that is just a great point. And then that was another question I want to ask you is, do you have a typical analysis that you're running as far as what ROI, ROE, IRR you're looking for your portfolio for each of these properties?
Yeah. I mean, I wouldn't say it's a hard and fast system, but basically like we've got a big spreadsheet that we plug the numbers into. And if we can end up with a product that is worth more than we put into it, and there's a path to getting our money out, not even that. I mean, a lot of times we're looking for a path to getting our money out within a couple of years, 2 or 3 years in a refinance. But if the DSCR works and the property pays itself down over time and we've got positive cash flow on it, we're not like, oh, it's 15 0.1% and we were looking for 15.5%, so we're not going to do the deal. It's more of a like, does this logically make sense, and can we deploy some cash into this and do something that, because we're often investing in areas where we have other properties, so it also helps our other properties to have other good properties near them. So.
Oh, sure. Absolutely.
Awesome. And I want to give you a shout out to Dan for using all the terms that we learned yesterday from the guy we interviewed about doing his syndications and how he analyzes them. Dan was literally like, I wonder if
I was like, this guy has got to know. I'm going to sound so smart.
Coming in here like an expert, like this, you've just been analyzing these for years.
I mean, I can tell you on the syndication piece, we haven't really syndicated any of these deals, so to speak.
Yeah.
But we have syndicated like multifamily apartment complex deals. One like 62 unit vacant and condemned project that we started last summer. And that one, I think our target, we ended up like kind of return to the limited partners. Our target is somewhere around 14% on that one. And we're gonna smoke that based on what we're seeing already. But so we do in the cases where we're bringing outside money in, we're a little more stringent on what we're looking for because we need to attract investors.
Yeah, absolutely. Yeah.
Awesome. Very cool. Well, that's cool. Like that's some unique stuff though. Like always have these sort of conversations with people. It always gets my brain thinking because we have like a lot of historical sort of stuff downtown here that would be rife for that. Problem we have here though is there's like two asshole families that own like everything and refuse to
and a shitty city council that will make anything unprofitable if you wanted to redevelop it, like quite literally.
Yeah, that's tough. That's one thing we have going for us, at least in this town that I live in and that we've invested a lot in, is the council is fantastic. Like they really understand what town needs, and they're out there getting great money and doing great stuff for town on their own, and it's bringing other investors in here too.
What size, like how many people live there, for example? 100,000, 20,000?
Like this little town, I think the population is probably like 4,000, but there's a town below us that's like a giant suburb of Pittsburgh, and there's like 35,000 people there.
Gotcha. Okay.
Like everything around the town that we're in is going to turn into suburbs, basically.
Right. Like you mentioned earlier, path of progress, likely.
Yeah. So we don't have like a metro system here like we had when I lived in DC. It was really easy to see where the development was going there. You just look at the metro stop like that was done, and then you like look at the next one that was super rough, and it's like, oh, well, that's where the next one started. We have a couple of big highways, and this is just one exit up from that giant community.
Okay.
Yeah. Awesome. Very cool. Sweet. So yeah, lots going on. And then I know you've been shifting towards the multifamily stuff as well pretty heavily recently. And that's one of the reasons that you started working with us, and we've been running some marketing for you to find you some different opportunities. And you actually told us before the show that you sent out your first contract actually from the marketing started doing for you just over 2 weeks ago.
Yeah, man.
So you want to break down that deal for us?
Yeah, absolutely, man. We're pumped. So I think realistically, like we've been now working on that for 2 weeks, and we've had a bunch of leads to call on, and they've all been like real people, which is great.
Yeah,
it's helpful.
And so we have one that we're actually going to execute on. It's like a relatively small deal. It's a 4-unit kind of townhouse complex that was built in the early 2000s, right close to where we have a bunch of other stuff. And we presented them with a couple of different options, and a lower cash offer, and then a couple of creative financing offers where we mixed in some seller financing to the deal, and we ended up at $425K. The seller's going to hold a 25% second lien position note on the property, and our lender's going to finance 75% of the purchase. So there might be $5,000 or $7,000 out of pocket to us in the end of the day.
So awesome.
Yeah, and it will kind of return to the company, when you combine the management fees that we charge ourselves because we do our own in-house management, and then kind of the leftovers at the end of the year from kind of the net profit, somewhere between $10,000 and $15,000 a year on an ongoing basis for $5,000 to $7,000 out of pocket.
Yeah.
Ooh, that's a 33% ROI. No,
more.
66% ROI. No, 300% ROI.
It's close.
Try to do it. That's so funny.
Oh man,
Actually,
I'm so worried you went and met with our accountants today, Dan. Like,
just try to sound smart.
Yeah.
No, that's incredible.
Anything, it's easy. Percentages are funny when you look at small numbers, because it's not a huge number coming in, but 100% money or 200% money on $5,000 every year is great. I mean, I'll take that all day.
Yeah. All day long. That's actually a really good deal. And your cash offer, what was your cash offer compared to this creative financing offer?
385.
385.
And we're under contract at 425. The property is probably worth 500. So
nice.
That's a great deal. And that I love the options, like when you're dealing with a good seller, like a logical seller, and you can give them options and they pick the best one for them, which also is a great one for you, for them to do a seller carryback on the down payment. I mean, that is a great deal.
And sophisticated guy, doctor, just was, and has like a brother-in-law partner on it, and just kind of ready to move on to something else, but they still like the idea of having a little bit of cash flow. So in this kind of current interest rate environment, I really think you have to get creative on deals to make them pencil.
Yep.
Until sellers really, on the larger stuff, adjust their expectations. I mean, we're still seeing, sellers that want, a 6 cap on a 35 unit apartment complex in Pittsburgh, like not in the city. That's kind of like workforce housing. It's not happening anymore. It's time to adjust.
Yeah. Yeah, I think that's super valid. And I mean, that's something we work a lot with our instant investor folks too, is like trying to find those different opportunities when like the cash offer doesn't make sense. And, I'm stoked that we were able to get that opportunity for you from the marketing and stuff that we've been running for you. But the fact that you had the wherewithal to recognize that the cash offer wasn't going to work for him. And then I'm assuming that you're the one that pitched the seller wrap, unless the guy was sophisticated enough to do that himself.
No.
He might have been.
We definitely pitched.
Yeah.
And I went and met him. So like I was like, just come up, we'll have coffee, we'll talk, because he was pretty local. So
That's great.
I think he liked that too. But yeah, I mean, I love making deals. That's what I'm the best at. So it's fun.
And that's how you're a pro too, is when you can start to think about things that way and find those gray areas that I say gray areas. You find those unique opportunities that 95% of the people don't even think about. And I think especially right now, as you're going into like higher interest rates, they just raised rates again. Anything that you can do to even like capture that debt, like we're starting to see a lot more people that are doing like subject twos on like larger multifamilies where they're taking over like a 4% debt and these different things. And that's going to be so mega in the next couple of years.
And in these creative finance type deals, especially if the seller's holding the note and you're like a reputable person or company, like it's a win-win for like everybody wins. Like it's great. They get ongoing cash flow. We get the property, they get a bunch of equity out. It's awesome. So it's cool to put together a deal where everybody feels good about it and is happy with the result.
Mm-hmm. Yeah. That is nice. That is one of the down things I will say about wholesaling is most of the time, not all the time, most of the time, we are their last resort.
Yeah, so it's not always a good feeling for them.
No, it's not, and like, sure, people can have like a good experience. We can help them out as much as they want. But like a lot of times, it's people that have been just going through shit for like the last few years even, and then find they're just like, you know what, we got to just like offload this thing. Yeah. We can't afford to fix stuff anymore. We are going to lose the house. Like we have to just dump it.
Yeah.
Yep. So cool. That's awesome, Eric. So, what's coming up next for you guys in the future as you're sort of continuing to, keep chasing deals? Like what exactly are you guys trying to put together with Rice Pegher Capital?
Yeah. So, I mean, one thing I did earlier this year before kind of making the jump over and moving into this full time is, I read a book that I don't know whether it was who recommended it to me, but it's called Vivid Vision. And man,
great
that
book.
Was so helpful. It was a book that I read and took the time to kind of do the exercises laid out in the book and kind of create this 3-year vision for Rice Pegher. And that just like clarified a bunch of things for me. So, I stopped counting doors because I think it's a stupid metric. I just think about it more in terms of like, what is the gross, value of the assets we have within the company. And I made those targets. So, in the target is to have 100 million in assets in Rice Pegher within 36 months. That was, 9 months ago when I did that. So we've still got a ways to go. But it's funny because like I see that number and I want to march toward it as fast as I can, but I also am trying to be patient right now because I know we're experiencing this shift in the market, and I want to grab deals, but I'll have to just like satisfy myself with smaller creative deals or larger creative deals if we can find them until the metrics make sense again, and then we'll go hard and go get some bigger stuff, some 50, 100 unit stuff.
So barring the fact that, maybe the next 12 months might be a little rocky on the acquisition side, when you set that vivid vision to do 100 million under management, did you change anything immediately in your business? Or was it just like, we have the processes, let's just keep marching forward as is?
Yeah. So we started to add more processes and started to add people. So at that point in time, we had 1 maintenance technician and 3 partners, none of whom worked full-time in the company. So I moved full-time into the CEO role. We hired a full-time property manager in the company, and we hired another maintenance technician as well. So we're starting to build some processes inside the company that allow us to layer on a 50 unit or a 75 unit. And it's not like we have to start from scratch. You just fold it into the mix and you release the units up, and the systems are already there. So that having that, trying to grow to that scale, which is still small by a lot of people's, metrics, is not possible without some systems in place.
Sure.
You hired a full-time in-house property manager.
Yep.
I mean, we got to do it. We tried to do that.
Awesome.
And then he sucked and we fired him. But like, it's just a hard thing to find somebody to do that, I think.
So who's on your staff then, like right now, and on that side of your business?
So 1 property manager, 2 maintenance technicians, and then myself. Those are the only like full-time paid employees. And we've got a bunch of, kind of third-party contractors and service professionals that, help with our business, but aren't, on the payroll, so to speak.
Right. And that's how many doors are you guys managing right now?
I think we have about 140-ish right now, like 15 million in assets.
Okay.
Nice. Awesome. Cool. Those are all things we got to get to work, Dan. We need some of these.
I know. We do.
He's the bullshit. So we're always running around trying to do stuff that we definitely could. But it's kind of tough because like with ours, we don't have as many doors. So you don't quite have enough problems to like keep something like that busy all the time. But like, it's just enough that it detracts from us being able to do what we're good at every single day.
So we didn't have enough like to start, and I'd say we're still slightly operating in the negative in terms of like our costs and of personnel. But I have the path mapped out. Like I know what we need to do.
Right.
To get the pot.
So
it helps me get there much faster if I have those people and processes in place already.
Okay, so I have 2 questions on that. So when you said 140 doors, are those all your doors that you're managing, or is there other people's doors under that management?
All ours, but some of them are syndicated. Yours. Like a chunk of chunk, like the 62 units are syndicated. So mostly ours with some syndication, but nothing third party.
But you charge all of those doors 8% basically. Right. And so when you say you run a negative, probably your fee should maybe be 10% to cover your costs, but or whatever that should be to cover your costs. But that's not your path. It's 8%, and your path is adding more doors to reach scale.
That's right.
Okay. I just wanted to clarify that. That's interesting to know, because I think it's important to recognize is like, this is our business model and we're going to get there, but you do have to invest. That's what we're doing, is investing in your company a little bit until you get to that point to where you are at scale and you are, what do they call that? Like minimum efficient scale or max efficient scale or whatever, where you have enough and you're actually profitable at that point.
Yeah, exactly. And it's also helpful. The guy that runs our management is awesome. He's a young guy. He's hungry. He's entrepreneurial. And like knowing where the numbers are and knowing that like he's in his business in our business is in the red is motivating to him. He's looking to keep things lean, add revenue to his piece of the business to get himself in the black. And I think that's helpful because he is an entrepreneurial guy, he's a smart guy. So I think it's cool to do it like that.
Yeah, very cool. Awesome. I love it. Lots of big things. Cool. So as we sort of get to the end of our time here, I want to dive into our final questions with you, Eric. first off, the crowd favorite question: what is your craziest real estate investing story?
Oh man, there's a lot of good ones. I would say that it was one of the things that led me. It's a story related to one of the things that led me to become a real estate investor. So,
Okay.
Real quick backstory in DC. When I first got to DC, it was 2009. It was the height of the great financial, crisis, and there was foreclosures everywhere. So like Bank of America and other countrywide, other banks were our clients. So I sold hundreds of foreclosures down there, lots of them to investors that I helped with their redesign process and lease up process. And I was, damn, all these people are making all this money. One property in particular that went to an investor, I was always the first guy in the door with like the drilling out the locks. And I was like in DC. And, so I'm drilling out the locks on this really rough property. And, I go in and I'm like, oh man, there's just a bunch of crackheads in there. And I was like, I'm not going in. So I call the police and I wait out front. 45 minutes later, the police show up. They go in the house. I'm waiting out front. They go in the house. They're like, just wait out here. And like all of a sudden, all the second floor windows on the property just open up. And they're just people jumping out of the house. like
Oh my gosh.
crazy, dude. The guy runs right in front of me in just his socks and like his underwear, running down the street, just kind of running from the cops. And they're busting everybody out of there. 5 minutes later, they come out. They're like, okay, we cleared everything. We're good to go. And I was like, did you go in the basement? And they're like, yeah, the basement's good. I was like, well, it's pretty dark down there, and I'm just me, and I don't have a gun. Can we double check that? And it was like in DC, there's a lot of doors under porches, and they're like separated English basement style apartments. And so we go down and we knock on the door, and these two people just answer the door. These crackheads just answer the door. And there's they're like, can we help you? And we're like, did you not hear 10 police officers inside running around, busting everybody out of there? And like, no, we were sleeping. There's no lights down there. There's mold all over the walls and the ceiling. It was crazy. I mean, it was just, that was the kind of shit you dealt with. But that house today, that house probably sold for $150,000 at the time. That today is an $850,000 house.
Yeah,
man, house full of crackheads.
Yeah, that's crazy. Yeah, we've definitely had our fair share of those too. So that's pretty good though. So that was actually before you even started buying. That's back when you were just
back when I knew
hustling.
That I needed to buy some crack houses. That's
Hey man,
that's funny.
Crack is not always whack.
Right.
What? I think it is.
I would argue that point, but you're the host, so I wasn't.
Yeah.
No, see, because without crack, you wouldn't have crack houses. Without crack houses, you wouldn't have investment opportunity.
Well,
so it's not always whack.
all right, okay.
Oh my God!
Just go with it.
You're just full of it today, Dan. You must have had some drinks with our accountant at lunch or something.
I did, totally.
All right. So next question: what's the number one piece of advice you would give for a new investor looking to get started with the real estate investing journey, or in a kind of lightly established investor looking to take their business to the next level?
Yeah. So if you're brand new, just no deal is going to be perfect. Go buy something and do something. Even if you lose $5,000 on it, it's the start of the journey. And if you're already investing and you want to do more, you just put another zero on it kind of thing and take that next step and find a partner if you need to. But just hustle and get yourself to that next level, because it's not as hard as it seems, in your mind.
I think that's the biggest thing is limiting beliefs. I know a lot of people definitely struggle with that.
Yeah.
Even as you start to grow, that even starts to continue. And it's,
right.
You can reach that one milestone of I don't know, $1 million net worth, you have 50 properties, whatever. And then all of a sudden it seems like it's so easy, but then you go to a, meetup somewhere and you meet someone that's your age that's worth 25 million and they have 5,000 properties and they're talking to the guy that's worth $1 billion, and it's just it's always about taking that next step. So awesome. So wrap up, Eric, where can people follow along, see what you're doing, and potentially reach out to you if you would like them to?
Yeah, awesome. ricepegher.com. And you can get me at Eric at ricepeghercapital.com, RICEPEGHER.
Perfect. Easy enough. Any socials?
Yeah, there's Rice Pegher's on Instagram. I think for sure. And I think you could just search that and find it.
Yeah. Okay. Perfect. Easy enough. Eventually, we're gonna have someone on here that's a real estate investor that is doing real estate content through OnlyFans. And,
We will, and we will sign up for it.
That'll be the goal. I'm honestly surprised no one has done that yet. It's been like, hey, I'm a guy that talks about like, creative financing on the porn social network.
There's got to be somebody on that.
They're trying, but I haven't heard about it yet. So their marketing sucks.
Yeah, that's right.
So, all right, cool, Eric. Well, thanks so much for hopping on, man. We really, really appreciate your time, and you got some good stories. You're doing some big things, and if you guys enjoyed the show, please go and subscribe wherever you listen to your podcast. Leave us a 5-star review. And besides that, anything else from you, Dan?
No, this is a lot of fun, Eric. Good to hear from you and all these cool stories. Can't wait to hear some more cool stories about crack houses. So crack is not always whack.
Yeah, that's Dan's new favorite.
Not letting it go. Not letting it go.
For how much you complain about all of our crack houses, I didn't realize that they were secretly just like yours. So we'll find some more for you.
Thanks.
Awesome. Thanks, guys.
Cool. All right. Thanks so much, everybody. Talk to you next week.
Yeah.
Thanks for listening. Please leave us a review on iTunes or wherever you get your podcasts. And check us out at collectingkeyspodcast.com for tips and guides on starting your own real estate investment and wholesaling business.